Good afternoon, traders. Well, we need to zoom out and take a look at the broader macroeconomic picture and charts. So this Friday, that's what I'm going to do. I'm going to attempt to review some of the charts that we've been keeping an eye on to help us understand where our economy is going to go over the course of the next few months, half year to year. And this will in turn help us to understand how our crypto space may be impacted. So without further ado, let's get started. I'm going to jump into the dollar chart right now. We cover this in almost every video update. As you know, the dollar has been fairly strong, all right? And this is, of course, because of the Fed's decisions to pause interest rates at high, I think it's 5.3 or something like that at this point. And we are still paused. Now the market, if we zoom in here, is anticipating that the Fed is going to start dropping, at least one drop before the end of the year. Market, of course, likes to be ahead of the game. Therefore, the dollar is dropping. All right, the dollar tends to drop when the market anticipates a Fed cut in rates, and this is because it makes liquidity, it increases liquidity, makes the dollar more accessible, and therefore it drives down the uh, the buying power of the dollar. And I just realized I forgot to snap over to my disclaimer. Let's get that out of the way real quick. All right, so the dollar continues to drop, and where can we anticipate the dollar will finally end up? Well, you can see that we have somewhat of a double top pattern. I have an arrow pointing to a trend line, a pink trend line here. I think we can fully expect the dollar to be at this level by the end of the year. All right, and what that means for the markets is the markets may continue to uh, blow off, complete that blow off top pattern that I've been talking about so long, of course. On the SPY, which we're going to look at in just a second, we are nearing our target, so we'll discuss that very briefly as well. But the dollar will continue to drop in my anticipation here, though it may not drop as quickly as the arrow indicates on my chart. I think we will get to this pink trend line. And so we have a little ways in the US stock market to go up because, of course, when the dollar gets weaker, it tends to help increase the price of stock markets. Now, that doesn't mean that people are uh, making more money. It means the dollar has less buying power, so the perceived effect is priced into the market, and that perceived effect is seen in prices, of course, and increases. All right. Really, what's happening here is this is just a secret tax. Inflation is just always has been a secret method for taxing the civilian population, the citizens of any country. Anyways, I won't get into that at this point. With the dollar dropping, we hope to see the VIX low, and yes, that is in fact the case here. So, dollar low, VIX low. I say it all the time. We should see the market hopping, and it still is. All right, here's our SPY. This is what I've been tracking to anticipate U.S. stock market moves. And you can see, first of all, let me get out an arrow here so I can point to what I am talking about. Down here on the RSI, we have a trend line. And I'm going to increase this chart here so you can see it a little bit better. And we're currently sitting on support right now. All right, so I anticipate we will have one more bounce, but at some point this support is going to break. And we've been on this support since April of 2024. Now, let's talk about that target of 570 on the SPY. And those of you who have been my followers know I've talked incessantly about this in my videos. Where did I get this from? All right, well, first of all, we have two things going on this chart. If I zoom up far enough, you can see I started an Elliott wave pattern. Wave number 1 right here, drop. Wave number 3 tends to be more exaggerated than number 1. In this case, it was 2 times the length of wave number 1. We had another drop. Wave number 5 tends to mimic wave number 3 and can go even farther. All right, so I'm not an Elliott wave technician. I need to look to other technical patterns to help me determine where we arrive. And I found this inverse head and shoulders pattern. Let me get my arrow situated here so you can see that a little bit better. We have a left shoulder here, a head, a right shoulder, and what I did is I drew a measurement from top of the head to our neckline, which is right here at 459. That gave me a target of 570, and I'm pretty sure we're going to, well, we've already got near it, so we may tag that and even blow past that. That's what a blow off top is, right? Nobody really knows where this market ends up, but I can show you from the charts we have a little time before we get to our top, and I'm going to show you that in just a second. We're going to jump over to our housing market chart somewhere in this video, and I will show you why. I think we have another possibly up to 4 months before we hit our top. So as I posted this week, I have taken actually 50% of my profit. I've held this, held my position in the market for 2 years. I'm taking 50% off, going to cash at this point, going to let the rest ride, see where we go, and see if we can break this target of 570, 571-ish, all right? And if we don't, no big deal. I'll pull the rest out if I have inclinations that we start to drop. All right, I'm going to pause the video so I can gather my charts here and my thoughts, and we'll move on. Okay, I think I'm going to cover this housing market chart next because it does explain why I still think we may have about anywhere from 2 to 4 months left of price action in the US stock market going up. This was a chart that I created, it's got to be a year and a half ago now, maybe a year ago, something like that. Anyways, let me see here. It had to be at least a year ago. All right. So there's a lot going on in this chart. I want to explain some of this. This is a chart that tracks the housing market index from the National Association of Home Builders. And what I've done here is I've created a band. You'll see this in red. Let me get out a black arrow again, guys, so you can see what I'm talking about. All right, so let's see this band right here. This is what I have charted as the weakening demand zone in the housing market price. Let's go back to 2006 when we had that housing market crisis. All right, so right here you can see we crossed down through this weakening demand zone, and there's a couple of things that I want to point out that occurred. First of all, the Fed was still while we crossed down, increasing rates. All right. They increased rates all the way up to here. And then you can see this green circle outlines the fact that uh, 14 months after the housing demand fell below the weak zone, the Fed eases rates, or they just paused rates. They just flat out paused rates for 14 months. All right. And all the while, the housing market continued to crash. Now, what was happening here in this purple line? This is the Dow Jones Index. All right. So 17 months before the market topped. All right. So if that stands, all right, that leaves a 14-month pause, 17 months before the markets topped. That gave 3 months difference there in this case before the Fed finally started easing interest rates. All right, from the start of housing market crossing below this weakening demand zone. Now, fast forward here to today. All right, I first noticed that we had crossed below this weakening demand zone right here, and that was in September of 2022. Now, obviously, we popped back above it, actually a couple times here, a small pop here. We are now back below this. Really, guys, this is another pattern that I see in doing this video. Benefit of doing these videos live. We have, that should be a green, a red triangle, because that indicates that is a bear flag of sorts. Now, why do I say it's a bear flag? Because we are down, continuing the trend down, and we've just created a flag here of stagnation. And I think before the end is over, you'll see us drop from this triangle, and housing markets, the housing market is about to crash. But again, the same pattern exists in which when we cross below that zone, the Fed was still continuing to raise rates. All right. So now we've had the Fed pause rates all the while the housing market continues to weaken. And it's really been a whole year so far that the Fed has paused rates. Now, over here, the Fed paused rates for 14 months after we dropped below that weakening zone. And it wasn't 17 months until the markets topped. All right, so that gives us a little time here. We still have, if history is any indication of what is about to occur, we still have a few months before this market finally tops. You can see the Dow way up here at 39,000. All right. So I still think that the market will, continue upwards while the Fed debates whether they continue the pause or reduction. Now, the market is obviously baking in one reduction before the end of the year, and you can see that in the dollar and what the U.S. stock markets are doing. So again, jumping back to the dollar chart, I would expect us to reach this pink ascending trend line in another 3 months or so, and that gives the SPY along with DJI and NASDAQ and all the other indices time to continue upwards price action. So I do suspect that 570 will at least be tagged, and I'm thinking, and I've said this all along, we could go as high as 650 on the SPY before we stop here. All right, so that is the reason why I've left 50% in. I've taken 50% off the top because I could be wrong, and chances, we are near that target. I've held for this long. We are nearing that target. I don't know for sure we're going to hit it, so just to reduce my risk, I've taken 50% off, leaving 50% on to see where we go. So here's our inflation rate chart, and this is where the Fed wants to see that inflation down to 2%. All right, so we're headed down. We had some good news with CPI numbers a little while ago, and that inflation rate continues to drop, and that is why the market is pricing in a rate reduction before the end of the year. And this is, of course, continuing to help out the markets. Meanwhile, we have some bad news. Unemployment rate continues to rise. This is not a good sign, people. And there's plenty of negative signs out there. I think one of the leading indicators that I often utilize is the car market. The car market is starting to grow terrible right now. There are literally millions of new cars sitting on empty lots waiting to be leased and bought, and that just is not happening. So it is definitely a lead indicator to what is about to occur in the US economy here shortly. And when I say shortly, I say within probably before the end of the year, but could go into next year before we finally feel the effects of what is about to occur. Single family homes continue to drop as well. You can see a big bear flag right there. We draw it out for those of you who may not recognize it. But yep, single family homes. Price of homes is just too expensive. Nobody can afford them, guys. And so we're in trouble here. And same thing with U.S. housing starts. The chart looks exactly the same. So when this housing crisis starts, I expect regional banks feel it first. Now here's a chart that's very interesting. I've got a level here at 52. Regional banks have hit that level. Now, see the big red arrow? I expect us to go down and hit our support at 40.94 currently, somewhere around there. This line comes all the way from the start of our secular bull market in 2009. We have basically remained above this red trend line. So when we start to really get into recession, I expect us to drop it below this red line, and that will signal, here we are, here we go, we're in recession, and the potential for depression at that point obviously becomes greater. Now, we also got some news out of China recently. 40 regional banks have failed, smaller banks, and they're being absorbed by the larger banks. But this is indicating what is starting to occur in China. China is losing the ability to continue to prop up this fake, bogus market. And you can see it's reflected on the SSE composite index for the first time since 2005. Now remember, China leads the market, the economy. So 2005 is when their secular bull market began, and they've always remained above this line. We have seen recently, especially with the news of those banking collapses, that they have dropped below. So we got to watch the Chinese economy closely, because it also does help signal what is to come. All right, so guys, all of this will impact the crypto market eventually. I know, and I'm still under the persuasion that we're going to hit 95,000 on the Bitcoin before the end of the year. I'm thinking November, December, but it possibly could play over into 2025, and we won't get there till January, February, March. I do think we'll hit that 90 to 95,000 on the Bitcoin. But once the full effects are felt here in the US, especially because we tend to lead the crypto community, that will spill over into our crypto market. Let me jump to the Bitcoin real quick. And I'm going to show you one last thing here before we call it a day. This is the inverse head and shoulders pattern I have, and that targets that 85, 90, 95,000. You can see this channel here that we've existed in basically since February. And again, I said if we break this channel, if we break down below this channel, look out. We are coming to 48,400 before we continue. We're going to retest that neckline, and that would be before we continue our way up and pop off all the way up to 85, 90,000 before this bull run is over. All right, guys. Hopefully this all helps. You see a broader overview of where we're heading economically. That is my video for today. Peace, y'all. Until the next video.